A very good morning to everyone, and thank you so much for joining us today. It's great to be back after a short break and to be presenting on our first episode on Pay As You Earn today. This session will focus on the determination of Pay As You Earn on regular income, and subsequent episodes will focus on more advanced Pay As You Earn aspects. My name is Jamie, and I'm joined by Sherlyn, who will be co-presenting with me today, as well as Brandon from our training team and Darren from our customer experience team, who will be presenting on the topic today. So today's session will focus on Pay As You Earn on regular income. Episode 2 will look at the determination of Pay As You Earn on irregular income. And then episode 3 is the last installment, and we'll examine more advanced aspects of Pay As You Earn, like fringe benefits, allowances, taxable income deductions, and tax credits.
Hi, everyone. I'm Darren, and I'm joined by Brandon.
Good morning.
So we're going to start with the first poll question. And the poll, it's a true or false statement. And the poll statement is, SimplePay automatically calculates Pay As You Earn based on an employee's salary. We'll give you guys a few minutes to answer that, and then we'll go through the results together. Okay, so we have the poll results back, and 99% of the attendees answered true. Brandon, is that correct? Does SimplePay automatically calculate Pay As You Earn based on employee's salary?
So 99% of the attendees are absolutely spot on. SimplePay does automatically calculate PAYE for you. We automatically add it to your payslip, so you don't need to add anything to any payslips. We will automatically add it. We've already built in the tax tables into the calculation, so you don't have to do any updates when the tax tables change. We do everything on the back end. All you need to do is go into SimplePay, process payslips, and the PAYE will be automatically calculated for you.
Okay, that's good. So in simple terms, SimplePay does all the heavy lifting when it comes to tax.
Absolutely. We're trying to keep our customers compliant as far as possible. And we know that many of our customers are small and medium-sized enterprises, and they might not have had extensive payroll training. So we try and do all the heavy lifting for you so that you don't need to worry about any of that.
Okay, that's great. Brandon, before we jump into tax on regular income, can you provide us with what is regular income? And then can you provide us with some examples on that?
Sure. So when we're talking about income today, we're actually talking about taxable income. So taxable income actually extends beyond simply income. So you've got your income such as your basic salary. You've got also your allowances such as the travel allowances. You've also got your fringe benefits, maybe a medical aid that's paid for by the company. And those other aspects we're going to be dealing with in webinar 3 or episode 3 of this webinar series. So for the purposes of today, we're just going to keep it simple, and we're just going to focus on basic salary when we talk about income. And when we're talking about regular, we're talking about things that are paid on a frequent basis. So when we're talking about regular taxable income, we're talking about things like your basic salary, like your medical aid, like commission, compared to something that's paid on an ad hoc basis, like an annual bonus, which is what we'll deal with in episode 2 of this series.
Okay, so regular income is any income that is paid on a regular basis, expected to be paid on a regular basis. Okay, thanks, Brandon. Okay, so the next thing I wanted to ask is there any way where you can capture regular income for employees that you've previously recorded payroll on for the same tax year on another payroll system when adding them onto SimplePay?
Okay, so if you are joining SimplePay in the middle of the tax year, then remember that the calculation that we do requires the previous information that you've captured. So the previous information on basic salary, on the PAYE that you've paid, on your benefits, etc. So you are able to capture this information using tax take-on balances on the system. So we have built in an option so you don't have to go and recreate payslips from the beginning of the tax year. You can simply capture the take-on balances with the information from your previous payroll system.
Okay, and is there a way to do this in bulk, or is it simply done on an individual basis?
You can do it both ways, right?
Okay.
So if you had to do it on an individual basis, you'd simply go to employees, select the employee. So I'm going to select Michael Darling and edit info, and there you'll see the option for take-on balances over there. Now, this option will only be available if take-on balances are actually applicable to the employee. So in other words, they've got a pay frequency that starts in the middle of the tax year, but they were employed either at the beginning of the tax year or prior to the tax year starting. You can also do this in bulk. To do this in bulk, you'd simply go to employees and then bulk actions. And there under more payroll inputs, we've got take on tax totals. And that's where you do it for your employees in bulk.
Thanks, Brandon. Before we continue with the session, we're going to just do another poll, and you should see that appear on your screen anytime soon.
Sure.
Okay, so this poll relates to the tax method used. So you'll see that the question is, which method of calculating pay-as-you-earn does SimplePay use? I'll give you a few minutes to answer that question. Okay, so you've got the results back, and 72% answered that choice 1 and that refers to the cumulative tax method. Brandon, what method does SimplePay actually use to calculate pay-as-you-earn liabilities?
So it's interesting to see the split there. The 72% of the participants are correct. We do use the cumulative tax method. And essentially what the difference is that the cumulative tax method takes into account all of the earnings that the employee has earned, for lack of a better word, during the course of the year when calculating PAYE, whereas the periodic method will only look at the earnings for this payslip when calculating the PAYE. So it's going to look at it in isolation, whether it's a month or a week, whatever that payslip period might be for, it's only going to look at the earnings in that period when calculating PAYE.
Okay, so looking at that, the cumulative method seems to be the more accurate method, especially when you have employees earning variable income, where the amounts could be different each payroll period.
Absolutely, right? So if we are looking at the cumulative method, we're looking at earnings throughout the course of the year, and we're looking at how it fluctuates throughout the course of the year, and we're determining an annual equivalent, which we're going to get to in a moment, an annual equivalent for them based on what they've earned. So we're taking into account all the earnings so far for the year, and this is a much more accurate calculation compared to the periodic method that simply looks in isolation at the earnings for this period without factoring in anything else that happened earlier in the tax year.
Okay, so Brandon, you mentioned the annual equivalent. On the cumulative method, how does SimplePay know exactly how to apply this method? Is there any way that SARS details or provides examples on how this method works?
Absolutely. So we often do get the question, where does SimplePay get this method from? Did you just make this up? No, we absolutely did not make this method up, right? It comes straight from SARS. And I'm actually going to open a document over here, and you'll see that this document comes from the SARS website. So it's sars.gov.za, and there's the URL. And this is called the Employer's Guide in Respect of Employees Tax for the 2023 tax year. Now, we are currently in the 2023 tax year, which runs from the 1st of March 2022 until the end of February 2023. A new tax guide new employer's guide is issued every year, but it only varies slightly with whatever small amendments there may be in legislation. And in this guide, if I scroll down to the table of contents, you'll see section 7.2 over here, which is on page 10. And if I click on 7.2, here you'll see that SARS outlines this whole method of how to calculate PAYE. And this is the exact method that SimplePay uses. So you'll see over here, we've got the first part that gives us a whole formula and explains what you need to do. And then they give you some examples as well beneath that.
Okay, Brandon, that's great. But there's a lot of words going on here. We see annual equivalent, we see in a formula. Can you take us through an example on how this tax method actually works?
Okay, so just to summarize how this method works, the first step is that we are going to calculate an annual equivalent for an employee. Once we've calculated an annual equivalent for the employee, right, using this formula over here, we're then going to determine the annual tax that would be payable on that annual equivalent. And then once we have the tax on that annual equivalent, we're then going to de-annualize that to determine what is the PAYE that they should have paid so far in the tax year. So what I've done is I've actually broken this first part down. So this first part says when determining the annual equivalent, we need to take the total remuneration received or accrued, multiply it by the total pay periods in a tax year, and then divide it by the total pay periods worked. Now I'm going to be working with monthly paid employees. but a similar method can be applied to employees that are paid weekly or fortnightly or twice a month, etc. So we're taking the total remuneration received or accrued. We're going to divide by the total pay periods worked first in order to determine an average that they earn per month. And then we're going to multiply by the total months in the tax year in order to determine the projected earnings for the year. That's essentially what an annual equivalent is. An annual equivalent is a projected earnings for the year based on what you've currently earned. And I've broken that down in this spreadsheet over here. So total remuneration divided by the pay periods or the months worked to determine the average per month, and then multiplied by the number of months in the tax year to determine the annual equivalent.
Okay.
Still with me?
Yeah. So just to rephrase, the annual equivalent is basically the average earnings the employee earned up until the year-to-date average earnings the employee earned multiplied by the number of payroll periods in the tax year, which in our case is going to be 12 if it's a monthly paid employee.
Exactly. All right. So I can take you through a quick numeric example if you'd like.
That would be great, Brandon.
All right. So I'm going to my employees and I'm going to open up Peter Pan, and I'm going to open up his payslip for April as well as his payslip for March. Now remember, March is the beginning of the tax year, so we want to start calculating it from March. Just going to scroll in here a bit so that you can see. So you'll see that on Peter's March payslip, he earned a basic salary of 20,000. Remember, I said we're going to ignore fringe benefits and all of that for now. So you'll see there's nothing else besides his basic salary on this payslip. And then we've got a basic salary in April of 25,000. So the first step in this process is to determine what is the total remuneration or the total year-to-date regular income. And in this case, it would be 45,000, right? Which is your 20,000 for March plus your 25,000 for April. We're then going to divide that by the pay periods or the months worked. So in this case, he's worked for March, he's worked for April. So he's worked for 2 months, and that gives Peter an average remuneration per month of 22,500. So yes, he earned 20,000 in the 1 month and then 25 in the next month, but on average, he's earned 22,500. And we're then going to multiply that by the number of pay periods or months in the tax year, which in this case is 12. And that gives us an annual equivalent or projected earnings for the year of 270,000.
Okay, so now that we know this annual equivalent, what's the next step in determining what the pay-as-you-earn liability is for the current payslip period?
So the next step would actually be to go and calculate what is the tax that you would pay on this annual equivalent. And that we're going to find out using the tax tables. So you can actually just type into Google rates of tax for individuals. And again, you will find this on the SARS website. And on this web page, you'll find the table of contents on the right-hand side. And here they show you all of the tax tables throughout the last couple of years, as well as the tax rebates and the tax thresholds. Now, as we mentioned, this employee we're currently in the 2023 tax year. This employee has an annual equivalent of 270,000. So we're going to look, where does 270,000 fall in our taxable income? And you'll see that it falls into the second bracket over here. And what that means is that we're going to be paying tax of 40,680 plus 26% of the taxable income above 226,000. So I'm going to start with the 40,680. I've just labeled that as the base amount for lack of a better term. So 40,680 is my base amount. And then we've got a variable amount, which is 26% of the taxable income above 226,000. So in order to determine the amount above 226,000, I'm going to say equals, and it's going to be my 270,000 minus my 226,000. So that's going to give me the amount above 226,000. And then we said that we need to multiply that by 26%. And that gives me 11,440. And when I add the two together, that will give me the total tax on the annual equivalent of 52,120.
Okay. So we've got this is the total tax the employee should pay on the annual equivalent. Is this the final amount that the employee would be expected to pay by the end of the tax year, or is there any deductions that can take place from this point on that tax liability?
So I know it's hard to believe, but SARS does actually gift us all with a little bit of a rebate. And essentially what the rebate is it says that there's a certain amount of tax that you don't have to pay as an individual. And that you're going to find on that same web page. And if you go to the table of contents, you click on tax rebates, you'll see the tax rebates are laid out over year for the various years, and you'll see the primary, secondary, and tertiary rebates listed over here.
And Brandon, how does SimplePay, because I see it's based on age by the looks of it, so how does SimplePay know exactly what rebate applies for a particular employee?
So it is based on age, right? So remember, everybody would get a primary rebate. So anyone, it doesn't matter what age you are, would get 16,425 Rand that they don't have to pay in tax. If you are above 65 years of age, you also get a secondary rebate. So you get the primary and the secondary. And then if you're above 75, then you get the primary, secondary, and tertiary rebates. Now, what we look at is we would look at the employee's basic info. So if you had to go to an employee and click on edit info and basic info, you'll see that the date of birth field shows that this employee is under 65, so they only qualify for the primary rebate.
Okay, so capturing the incorrect date of birth could essentially result in the employee underpaying or overpaying their tax liability for the year.
Absolutely. It's imperative that you do capture the employee's date of birth correctly. If you say that this employee is 80, but they're actually 28, then you are essentially giving them a second and a third rebate. And then on assessment, SARS is going to go, hang on, something's wrong here. This employee needs to actually pay in income tax. And obviously, that's not a nice surprise for an employee to get. So please do make sure that the date of birth is captured correctly.
Okay. So great, Brandon. So now we've reduced the tax liability by the rebate of 16,425. We got the yearly tax of 35,695. How do we go about determining the tax that should be paid for the current payroll period?
So remember this 35,695, that's just a projected tax based on the annual equivalent. So if you as an employee had to earn the 270,000 for the year, you would pay 35,695 Rand in tax, taking into account the rebate. But remember, we're dealing with pay as you earn. So we only pay in tax as we earn, and we haven't earned 270,000 Rand for the year yet. So if we go back to our legislation or our guide from SARS, you'll see that it says here, although the annual tax is determined on an annual equivalent, the employee will not be liable for tax on the annual equivalent, but for the pro rata portion, which represents the employee's tax deductible on the remuneration which was actually received or accrued. This is done by dividing it by the ratio which a full year bears to the periods in respect of which the remuneration was received or accrued. Now that's a lot of words. Essentially what it means is we're going to de-annualize this tax figure using the inverse of this ratio. So what we're doing is we're taking that 35,695, we're going to divide it by the number of pay periods or months in the tax year. So divided by 12 to work out what is the average tax that this employee pays based on their average earnings, and then multiply it by the pay periods or the months worked, in this case 2, to determine what is the year-to-date tax that they are liable for. So they should have paid 5,949 Rand and 17 cents by the end of April to cover the earnings for March and April.
Okay, so why is it that the year-to-date tax that we see on your example is different to what we saw on the payslip for April for this particular employee?
So if I go to this payslip for April, you'll see that the PAYE is only 3,624 Rand and 59 cents. And the reason for that is, remember again, it's pay as you earn. So you're going to be paying tax as you have earnings. And this employee didn't earn this full 45,000 in April. They earned some of it in March. So we have to deduct the PAYE that was paid in March. So in March, they earned 20,000, and the PAYE for March was 2324.58. So I'm going to deduct the 2324.58, and that tells me that for April, this employee owes or needs to pay 3,624 Rand and 59 cents. And if we compare that to our payslip, you'll see 3,624 Rand and 59 cents. So it matches exactly the manual calculations that we did.
Okay. Brandon, is there any way that on SimplePay that we can actually see this calculation?
Absolutely, Darren. So if we go to an employee's payroll page, so we go to their profile, and you'll see I've navigated to the April payslip. And over here, you'll see that the tax PAYE item is a hyperlink. So it's in blue, which means that you can click on it, and that will take you to the tax trace. If I click on the tax trace, you'll see that, yeah.
Sorry, before you continue, I just thought it's an opportune time to just have another poll session. So if we can just bring up the last poll, you'll see it appear shortly on your screen. So this relates to the tax trace. Thanks, Brandon. It's a true or false statement again, and the statement is the tax trace allows you to see how the system has calculated the pay-as-you-earn liability. We'll give you a few minutes to answer that, and we'll go through results together. Okay, so we've got the results back, and 99% answered true. So Brandon, take us through it. Does the tax trace actually show or give a breakdown on how the system calculated the pay-as-you-earn liability?
It does, Darren. So remember, we calculated at the beginning, we said we wanted to know what is the year-to-date regular income or the total remuneration, and we said that that is 45,000. And if we look at the tax trace, you'll see the year-to-date regular income is 45,000. We then said that we want to use that to determine the annual equivalent, and we said that is 270,000. And if we go to the tax trace, you'll see here it shows us the annual amount, which essentially is the annual equivalent, and that is 270,000 over there. We then said we want to calculate what is the tax on that annual equivalent, and we said that is 35,695. And if we go to the tax trace, you'll see the tax that was calculated is 35,695 on that annual equivalent. We then said we're going to de-annualize it to determine what is the year-to-date tax that should have been paid for March and April. And we said that's 5,949 Rand and 17 cents. And if we go to our tax trace, there you'll see we've de-annualized it by multiplying it by 2/12, and that gives us 5,949 and 17 cents. And then the last thing we said is we're going to subtract the year-to-date PAYE already paid of 2324.58, and that will give us our PAYE liability for the month or the period of 3624.59. And if we go to the tax trace, here you'll see we've subtracted the tax already paid, and that gives us the tax for the current payslip of 3624.59. So the tax trace shows you the breakdown of these important figures that we have now done in the manual calculation.
Okay, that's helpful when you have employees querying why the tax has changed if it's variable income.
Absolutely.
Thanks, Brandon. So when we were going through this cumulative method, I identified a few areas or few points that I want to raise with you. And that is basically, I see that the annual equivalent is always taking into account the number of payroll periods within the tax year, right? Now, what happens in a case when we know that the employee is only going to work for 1 month in the tax year? It's an employee that's appointed on the 1st of February, and they only earn 5,000 Rand for that month. Or let's say 10,000, let's say 10,000 for will that employee still be taxed on 120,000 annual equivalent instead of just taxing them on the 10,000 that we'll know they'll earn for the tax year?
So this is actually a question that we get quite a lot, so I'm glad you brought it up. I actually have an employee that's similar, maybe not the same figures, but let's just have a look quickly. So if I go to Captain Hook, oh, it is actually the same figure, right? So I've got Captain Hook, who was appointed, if I look at his basic info, he was appointed on the 1st of February 2023. So I'm psychic, I can see into the future. And I know that he's going to be appointed on the 1st of February 2023, which is the last month of the tax year. And you'll see that in the last month of the tax year, he earns 10,000 Rand. And you'll see that when we go into the tax trace, we've calculated an annual equivalent of 120,000. And because of this, he needs to pay PAYE. Now, we often get customers that contact us and they go, whoa, this person has just come out of university. This is their first job ever. They're only earning 10,000 Rand. So they shouldn't have to pay PAYE. You can clearly see here that this person is under the tax threshold. So I have two responses to that. The first response, Darren, is that, remember, we need to separate in our minds the difference between income tax and PAYE. So income tax is the tax on your earnings for the year. And in terms of income tax purposes, yes, you can see that this employee is clearly under the tax threshold, so they wouldn't need to pay income tax. PAYE is a method of collecting income tax. And SARS had to prescribe a method for employers to collect that income tax. And this method that they prescribe is this annual equivalent method. And if you go to this annual equivalent method, it says here, an annual equivalent must be determined when an employee's tax period is shorter than a full tax year. It doesn't say, okay, you can make the judgment call and say, okay, this person is under the tax threshold for the year. It says you have to determine an annual equivalent. And you can actually also see that in the examples that they give. So if you look at the example over here, it says a monthly paid employee worked for 7 months at the employer. So they were only employed for 7 months, and you'll see that they multiply it by 12 to determine the annual equivalent. They don't simply multiply the earnings by 7 or determine what the earnings were for 7 months. They do still project an annual equivalent. So that's the first thing to know, is that it is important to follow this prescribed method. Sorry, did you want to say something?
Yeah, I was just going to say, so there's no way, so SARS doesn't give any leeway to get around that. You have to apply the annual equivalent, regardless of how much income you think that employee would earn for the tax year.
Absolutely. So I know that some of our competitors do allow some weird behavior things on their system where they allow you to edit the PAYE, and because of that, people do use their own judgment and they do go and edit things, right? You're not supposed to. We are trying to keep you compliant with legislation, and that's why we've set up our PAYE calculation in terms of the guidelines that we've received from SARS. And we also belong to PAGSA, which is the Payroll Authors Group of South Africa, and they have also given us these guidelines on how to set up the system. So remember, I said the first thing that I said, we've got to separate in our minds the difference between income tax and PAYE. And the second thing is, when SARS determined this method, they wanted to determine a method that's going to take the worst case scenario into account. And you as an employer, you can see what's happening with your employee from the employment relationship that you have, but you can't see what's happening with their previous employer. So you don't know if you've got an employee that's worked for you for 1 month and they earn 10,000 Rand. You might not know that they've worked for another employer for 11 months and earned 300,000. And because they earn 300,000 with that other employer, they're definitely liable for tax. They're not under the tax threshold for the full year. So when SARS prescribed this method, they said, okay, we'd rather have you over collect tax than under collect tax. So they're going to assume that this employee was actually employed previously, and therefore you should calculate an annual equivalent. So I know some people, like I said, some people come to us and they say, oh, but this person was a student. I know for sure they didn't work for anyone else. Unfortunately, this is the method that SARS prescribes. And then the only way for that employee to get that tax back is for them to complete their tax return at the end of the year and for SARS to refund them.
Okay. Okay, before we dive into the refund part, Brandon, there was another case, and it's probably similar to this scenario that we've just gone through. But I was thinking about it for an employee that joins in the middle of a payroll period, for example. That income that they earn for that payroll, that half payroll period work, do we simply multiply that by the number of tax payroll periods within the tax year to determine the annual equivalent, or is there something that we have to consider when calculating the annual equivalent for those instances?
So my answer to that is it depends what you do on the system. All right. So if we take a look at, I think I've got another employee that got something similar. So let me have a look at Tinkerbell. So Tinkerbell we've set as having a basic salary of 5,000 Rand per month. And you'll see that under the basic info, she's employed from the 16th of March. So in other words, she was employed from the middle of March and she earns 5,000 Rand per month, which means that her annual equivalent would normally be 60,000 Rand for the year. But now what we've done is we've gone and overridden the pro rata percentage. So because this employee didn't work a full month, they would have only had a basic salary of, let's say, around about 2,500 Rand based on the period that they've worked. But we've gone and overridden this pro rata percentage to 100 to tell the system that they're earning 5,000 Rand for this half a month. So what the system is going to do is it's going to take this 5,000 Rand and it's not going to multiply it by 12 to get 60,000. It's going to multiply it by the number of half months there are. So it's going to multiply it by 24 essentially. Or if you think about it another way, it's going to take the 5,000 for half a month, multiply it by 2 to get it for a full month. So that would be then 10,000, and then multiply by 12 to get it for a year, which is 120,000. And then you'll see that this employee, based on the annual equivalent, they are above the tax threshold and they would be liable for PAYE on this particular payslip.
Okay. So I like the second part. You mentioned that we multiply the 5,000 by 2 to get the 10,000. So essentially what SARS is doing is they're calculating the amount the employee would have earned if they worked the entire payroll period. And that again guards against if the employee was employed for the other half of the period before joining your employment.
You just remember that this calculation is based on the information or the data that we have for year to date. So you as an employer, you might know, okay, going forward, this employee is only going to be earning 5,000 every month. But this calculation doesn't take into account what ifs, right? This is talking about the total remuneration that has been received or that has been accrued. Not talking about what's going to be happening in 3 months because we can't predict what's going to be happening in 3 months. So it's only basing the calculation on what you currently have earned. And if you currently earn 5,000 for half a month, then it's going to treat that as you earning 5,000 Rand for every half month in the tax year.
Okay. Now, Brandon, what happens in the next payroll period? Going on from this example, if the employee's income now drops to 5,000 for the entire payroll period in the next payroll period that we process, the annual equivalent will decrease because we're using the year-to-date figures, right? And the tax liability will decrease.
Exactly, right? So the system, every payslip, the system is going to recalculate the annual equivalent based on the year-to-date figures. So as we go on, if this employee's salary then is only 5,000 Rand in every subsequent month, then the annual equivalent will recalculate and the PAYE will become less based on this new annual equivalent as we go on.
Now, what happens in the case where that pay-as-you-earn liability goes into a negative amount, essentially meaning that the employee is owed money by SARS? What do we do in that case? You mentioned that we can't do the refund, but would the employee have to wait till the end of the tax year to get that refund?
So if I've got another employee like this. So let's go to employees and then I'm going to go to Wendy Darling, just show you an example. So you'll see that Wendy in March, she earned 20,000. And based on her salary of 20,000, she had to pay tax or PAYE of 2,324.58 because her projected income or annual equivalent for the year is 240,000. Then in April, her salary dropped from 20,000 to 1,500. So based on this new information, you'll see that the year-to-date income is 21,500. So because of this sudden drop in the salary, the average earnings that she earns per month is much less. That's dropped. And as a result, the annual equivalent has dropped to 129,000. And when we calculate PAYE on that figure, we determine that she only had to pay 1,132 Rand and 50 cents for March and April, but she's already paid 2,324 Rand and 58 cents. So in other words, she's overpaid PAYE for March and April, and there's 1,192 Rand and 8 cents that's owed to her. Now, SARS doesn't allow refunds on the payslip. And the reason for this is because this is a cumulative calculation. If her salary went up drastically now in the next month, so maybe it went back to 20,000 or 25,000 or 30,000, this essentially what's going to happen is this amount that's owed to her would then be offset against that next period, right? However, if it happened to be that this employee, their salary didn't go up again, and it stayed consistent at 1,500 Rand, the PAYE every month is going to be 0 on the payslip. Because SARS doesn't allow employers to refund tax, right? It would be 0. And then at the end of the tax year, this employee would have to then go and do their tax return with SARS, which in most cases now it is auto-calculated anyway. And then SARS would refund this 1,192 Rand and 8 cents to that employee.
Okay. Okay, Brandon, thanks so much for taking us through that. That's clarified the cumulative tax method for me, and I hope for all our attendees as well. Thank you so much, everyone that took the time to listen to us. I'll now be handing over to Jamie and Shirley.